Well, how's it going, friends and family? My name is Amos, and it's time for another stock analysis video. I want to tell you this right now. A high-quality dividend compounder, time and time again, they're going to find a way to rebound and rally to new all-time highs with due time. Right? No matter what the setback is, no matter what the circumstances are, they tend to be a beautiful contributor to anyone's portfolio. Case in point, let's take a look at Hershey. In the past 1 year, they had reached a high of about roughly $200 a share, and then they just sold off. Okay, at the end of December, that's when I started to dollar cost average into Hershey all the way down to their lows of about $140. And then they had their little rebound rally because I think the news broke out that Mondelez might buy them out. The deal fell through, and then they sold off again, but I guess if we only consider the past 6 months, they're up 12% into the green while paying a 3% dividend yield. Another reason why Hershey is doing so well right now is because they have tariff exemptions to import cocoa, which is one of the most important ingredients for their products of making chocolate candy bars. And that factor alone is going to improve their bottom line. But my question to you is, who is their cousin from West Virginia? Take a wild guess. I think I already said their name. It's Mondelez International. And by the way, huge shout out. This is the first stock analysis request. I did a soft launch on the Patreon. If you want to give it a go, look for the Google form link that's going to be in the video description and in the pinned comment. Basically, if you're curious about a stock that you keep daydreaming about, submit it to me and I'll review it on the channel, okay? This is the first one. We're going to be talking about Mondelez International. And you might be like, why Mondelez? Well, what you see on your screen right now is Mondelez's dividend profile, a 3.5% dividend yield, a 67% payout ratio, and for the past 5 years, they've been growing their dividend on average by 10.3%. Dude, that's phenomenal. And during the pandemic, when there were a lot of dividend cutters, did Mondelez cut their dividend? No, they did not. They grew their dividend despite all the headwinds. And they also operate in over 150 countries. Not just the US, but predominantly overseas, I would argue. And the best part is, if we take a look at Mondelez's stock price history for the past 1 year, negative 13.6%, they're effectively at their lowest price they've been for the past 365 days, but it gets better than that. If I zoom out 5 years, they're effectively at their 5-year low. So friends and family, let's take a look at Mondelez. We're going to examine if they are truly a good undervalued stock or if they're disgusting, poo-poo, dirty diaper, and I'm going to be placing them among their peers on the dividend compounder chart. If that sounds good with you, let's go ahead and get into it. So what is Mondelez and how do they make money? They're in the business of manufacturing and selling biscuits, cookies, candy, and even cheese. Mondelez is the parent company of some of the most iconic brands out there, such as Chips Ahoy cookies, Cliff Bars, what else we got? You got Honey Maid, Hall's Cough Drops, you've got Oreo cookies, you've got the Philadelphia cream cheese, Ritz Bits crackers, Sour Patch Kids, the Orange Tang juice mix, that powder, Triscuits, and Wheat Thins. Okay, so some of the most beloved brands in the grocery aisles, and yes, they all have a common theme. It's not exactly healthy for you, but I guess one could argue Cliff Bars, if you're a granola person, I think it kind of falls into that category of being healthy. But for the most part, it's sugary, it's sweet, and it's full of preservatives and not so healthy ingredients. Now let's talk about the recent developments that are surrounding Mondelez. They just reported their Q3 2025 earnings on October 28, 2025. I'm going to tell you right now, it was a mixed bag. There were some good and there were some bad. They beat the top and bottom line expectations, which I would argue is a phenomenal thing. That's the minimum standard you got to do when it comes time to reporting your earnings. However, they did cut their full year guidance, as you can see by bullet point number 4, because they're noticing less sales in Europe. And something else that's affecting Mondelez right now, I don't know if you're out of the loop, but the weight loss drugs, it's all the rage right now from Novo Nordisk, from Eli Lilly, and I guess Pfizer. They're trying to pump out their own right now. I think it's stuck in phase 2 or 3 in their drug pipeline, which means eventually, once it's mainstream and these weight loss drugs are more affordable and more accessible, less fat people are going to be eating snacks. And if there's less people eating these snacks, that means the revenue for Mondelez, Hershey, Campbell, and some of these other food CPG stocks, they're going to take a major hit, okay? Like, that's the reality. However, between you and me, I'm not too worried about that because 70% of Mondelez's revenue is made up from overseas sales. When we talk about Europe, when we talk about Africa, Asia. So, and if you can't tell by my accent, I'm an American. So besides the US, and maybe we can throw in Saudi Arabia, maybe Brazil, I think the war on being fat isn't really an issue in Europe or in Australia or major parts of Asia, except I think there are certain areas and regions of China where people are getting obese because of KFC, Taco Bell, Pizza Hut. But then again, I'm wrong because their numbers are decreasing ever so slightly. So maybe the weight loss drugs and the whole idea of eating these unhealthy snacks, maybe it is really having an effect on the customers, right? What I'm more concerned about is this. The United States government, they're imposing strict restrictions for folks that are using food stamps, EBT, WIC. You just can't buy junk food anymore. So the government's saying like, hey, we're only gonna reimburse or give you these food coupons if you buy healthy, whole foods. Now, there's a significant amount of the American population that rely on government subsidies and these programs in order to eat and get by. But my whole thing is, if you go to an urban city in the not so well-off part of town, dude, it's a food desert. Your only options, really, it's like fast food, Chinese restaurants, and convenience stores. You're not really gonna have a normal grocery store with all the bells and whistles with, fresh produce. So getting rid of that, I mean, I get it, but I guess I could read this for you, right? New SNAP rules explained 6 more states are restricting the purchase of processed junk foods. That's definitely going to affect Mondelez, PepsiCo, General Mills, and everybody else that sells these quote-unquote unhealthy foods. And which states are those, by the way? So Texas, Oklahoma, Louisiana, Colorado, Florida, and West Virginia starting in 2026. And then we can also toss in Arkansas, Idaho, Indiana, Iowa, Nebraska, and Utah. Correct me if I'm wrong, but I think in the past you could use SNAP benefits to get whatever you wanted in the grocery store that's qualified, including, candy, including snacks, including soda, but the rules are going to be a lot more strict. And I'm going to be honest with you, that's not going to be good for Mondelez, okay? I swear I'm not bipolar. On the flip side, some good news, the price of coca, it's trending lower and lower, which is going to improve their bottom line because the cost to do business, to make those cookies and biscuits, is not going to be an arm and a leg like it was at the end of 2024, which is why initially Hershey and Mondelez went on a massive sell-off because the price of coca was ridiculously high, like an all-time high, right? What is that? I think roughly $12,000 per metric ton. I'm assuming that's what the units are. And as you can see, the price of coca is just dropping fast and aggressively, which is good for these cookie and snack manufacturers. I would argue it's probably going to bottom out at the numbers that they were back in 2020, 2021, and 2022, roughly $1,500 per metric ton. We zoom out past 10 years, it's usually been very stable, but obviously because of the pandemic and the after effects, the supply chain and inflation all around the world, the prices just ballooned up. And that's why I saw opportunity in Hershey. By the way, I'm a shareholder of Hershey, and that's why I started buying shares of Hershey. Because for me, I saw it as a temporary setback. Now it's coming back down to earth. The life vest is being thrown into them, and now they can get themselves out of the pool. They're swimming out right now. All that to say, there's some good stuff happening for the company, and obviously some bad stuff. Mostly the SNAP and WIC benefits being slashed to buy their products, but also the weight loss drugs, those are the negatives. But their raw ingredient costs, coca, their bottom line is going to improve. And now at this point in the video, we're going to be calculating an inherent worth for the stock price of Mondelez. And, I ran all the different models. I think most of them spit out a very wonky number that just doesn't make sense. Their dividend profile is so beautiful that the dividend discount model, it gives you a price that's too rosy, too optimistic. And then for the multiples valuation, it doesn't make any sense because their peers, their PE ratio is like an 8, 9, or a 10. Whereas for Mondelez right now, they're somewhere around a 20. And so I defaulted to my preferred methodology of calculating an intrinsic valuation, which is predicated upon their earnings and the PE ratio that's generated from that. By the way, if you want this calculator, it's available on the Patreon. And the reason why I say that is because your stock price, it moves up and down contingent upon how you perform on these earnings reports, right? So the next one, the Q4, I think it's coming up in February, where basically you lay down a guidance saying like, hey, we're going to be able to pull off $1 of profits per share. And then you report, did you meet good on your promise? Like, did you generate $1 of profits per share? Or did you come in below? Or did you come in above? What that means below is like, you posted, 98 cents of profits per share, which means what? You overpromised and underdelivered. So what do you think is going to happen? Their stock price is going to get massacred, and consequently, their PE is going to get smaller because the EPS just got smaller. So having said that, what you see on your screen right now, in Q1 of their fiscal year of 2025, they generated 31 cents of profits per share. Doing the exact same thing for Q2, they generated 49 cents of profits per share, and Q3 was 57 cents. Now, the reason why I have Q4 highlighted is because the expectation on a GAAP accounting perspective is $1.42, which I hear you. That's a huge jump from the previous quarters in this fiscal year, but it makes sense, right? The cost of coca, which was murdering their bottom line, that's no longer going to be an issue. Their production facilities, they're going to be able to buy these raw ingredients at a fraction of the cost that they were back in December of 2024. So I do think they have the ability to execute and pull off $1.42. And in Q4 of 2024, they pulled off $1.30 for their earnings per share. So that's going to be an increase of 9%. Well, actuality, it's 9.2% year over year. So when you paint it like that, I don't think it's that severe of a jump. And I do think it's going to be possible. Now, if they come in short, I think that's going to be very, very a severe situation. I think Wall Street is going to be very emotional, meaning a slide of 5, 10, maybe even 20% in a single trading day is a possibility. Dude, I saw Pfizer, which is a fintech company. Dude, their stock got hammered like 45% into the red in one single trading day. So anything is a possibility in this stock market that we're operating in. It's super volatile. If you miss in your earnings or you give negative guidance, dude, your stock is going to get hammered beyond belief. And by the way, I'm referring to my notes. I don't want to forget. Like other CPG companies, Mondelez, they like to work with adjusted EPS numbers. But with my forecast, I'm going to be using GAAP numbers. So on an adjusted basis for Q4 of 2025, they're expecting 70 cents of earnings per share, okay? But their income statement, what you see on Yahoo Finance, Seeking Alpha, stockanalysis.com, it's not going to reflect that. They only use GAAP numbers, and that's why I'm going to be using GAAP numbers. Now, what I'm thinking is for fiscal year 2025, for them it ends in February 2026, I think they're going to pull off somewhere between like $2.79 of earnings per share, upwards of like $2.90. But I think $2.90 is a little too optimistic. So if they do pull off $2.79 of profits per share, and their PE ratio stays sticky at a 20, which what it is right now, then Mondelez could be around $55.80 come around February. However, historically, for the past 10 years, on average, their trading multiple, also referred to as the PE ratio, it is a 23.3. So best case scenario, I'm thinking Mondelez, they could jump up to 65. Now, they're currently trading for $55 a share, and I promise I'm not manipulating the numbers for it to represent 55. It's just what happens with the math that I'm seeing. So I think the reason why Mondelez is selling off in the previous weeks leading up to December the 3rd is because they're being priced accordingly. I think the markets are already pricing in that they're going to pull off $1.42 of profits for this fiscal quarter, and they're reducing the stock price accordingly by selling out of them. And that's why if you look at Mondelez right now, they're not undervalued. They're actually fairly valued, which is kind of crazy to say because as you just saw, past 5 years, they are at a 5-year low, the lowest price that they've been in the past 5 years. And something else that I want to call out is, according to their last earnings, the guidance that the leadership team gave is that they're going to see a 4% sales growth for the foreseeable future. So going into next year and the next 2 years, but again, I just want to reiterate this. Their margins are going to improve because of the declining cocoa costs. So what I'm thinking is year over year, even though their gross sales might only go up by 4%, roughly 4.5, maybe 5%, I'm thinking that their profitability and their margins will continue to increase because the cost to do business just came down, right? So I'm thinking 8% year over year is not too crazy. Okay, so if their earnings per share goes up by 8% in their fiscal year 2026, which should end in February of 2027, $3.01. And if they continue to trade at a suppressed PE ratio of about a 20.5, then Mondelez about a year and a half from now could be about $61.77 on the bear case side. When I say bear case, I mean like reality, realistic. This is the educated guess using very conservative or safe numbers, as they say. There's no such thing as safe numbers, but $61.77. However, if the markets change the way that they feel about Mondelez, and the PE ratio goes back up to a 23, and they still pull off that $3.01, then they could be about $70.21. And before I go any further, what you do have to keep in mind is that I'm being very, very, very bearish. Because in 2024, even baking in the really high cost to do business, because the cocoa bean prices, I mean, you just saw, right? It was ridiculous. They pulled off $3.42 of profits per share. So for me to say that their EPS is only going to be $2.80 for 2025 and then $3.01 for 2026, you can see how bearish I'm being, right? But I'm also baking in Ozempic. I'm also baking in softer sales in Europe. I'm also baking in the fact that millions of Americans are no longer going to be able to use their government benefits in order to buy junk food. So I do think that is going to affect their bottom line. Now, the next presidential administration will transition in about 3 years from now. So in 2029 going onward, I think things can change and go in their favor. The tides can turn, right? But going into next year, 2 years, 3 years from now, I don't see a catalyst that's going to change and make junk food and sugary sweets be relevant again. Now, with that said, I'm still invested into Hershey. I don't plan on selling out of them. I'm also invested into General Mills. But having said that, let's just go ahead and assume like, okay, they posted $3.42 last year. I mean, what would happen if they did that again and they continued to trade at a PE of a 20? Then Mondelez could be $68.40. Do I see that happening? I'll be honest with you, I really do not. I was playing with the numbers for a while, thinking, reflecting, and I'm like, dude, I don't think that's going to happen. I don't think they'll pull off $3 of earnings per share for this fiscal year. I just don't see that being a possibility. Now, obviously, that's not financial advice. It's just predicated upon what's happening. I think they can go as high as like $2.90, but it's better to be safe than sorry. I think $2.79 seems reasonable, seems sensible. Now, if we play this game and we continue on to 2028 and they pull off $3.51 of profits per share, which is really sad to say because that's only an increase of 9 pennies from their 2024 EPS. And their PE gets slightly elevated because now Wall Street's realizing like, okay, their margins are improving because the cocoa prices came back down. Their PE ratio is a 22. Then I'm thinking in about 3 years, Mondelez could be $77 a share. I think the upside from 55 to 77, it's not bad. especially when you bake in the 3.5% dividend yield that's growing at about 10% year over year. If you add all, you can't just look at one thing. You got to bake it all in, a holistic situation like you're applying to a college. I can't just be looking at your SAT scores. I got to be looking at the whole picture, right? Your extracurricular activities, your community service, your GPA. I think that's not bad on the bear side. Now, if their PE ratio goes up to a 23.3, which is their historical average, $81.89, the upside from 55 to 81, not bad. So that's what I'm thinking. Now, obviously, I could be wrong, but I think these numbers are pretty realistic. So when it comes to the compounder chart, where am I gonna put Mondelez? Okay, if they go onto the left side, it's a certified compounder. Your money invested into this XYZ company is gonna increase and go 100, 200, 300% given the right amount of time to allow it to marinate and bake in the oven. If they go on the right side of your screen, it's a Kager graveyard, meaning my money invested into them, not the wisest use of my capital, okay? So F tier, represented by Carter's, Baby Clothes, Chime Finance. S tier is obviously Google and Amazon, and C tier is an average company, okay? Which is kind of crazy for me to say, because all four of these companies, Sezzle, Duolingo, Lululemon, PayPal, phenomenal financials, phenomenal balance sheet. Everything looks pretty good, but their performance in the stock market, their valuations, it just doesn't make sense for one reason or another. And that's why I put them into the C tier, okay? Now, when it comes to Mondelez, where am I going to put them? Right next to General Mills. I would argue Mondelez is a C+, just like General Mills is a C+. Now, hear me out. What I like about Mondelez is that they have this tendency to just buy out and acquire the next up-and-coming snack brand. And to be honest with you, I like their portfolio mix. It's not like they're just staying steady with who they have. They're constantly buying out the next big snack. And I don't know about their leadership team, but I will say this. If they're smart, and I think the Cliff Bar, hold on, let me go over here. When you look at their recent history, I think they are making that slow pivot into acquiring and spending the money that's necessary in order to buy out the healthy snack category, right? In 2022, they bought out Cliff Bars, and they bought out a bunch of different players that manufacture protein bars, energy bars. So I think they're understanding the assignment that these Chips Ahoy's and Oreos, dude, if you grew up in the 80s and 90s, we're pretty lucky, okay? We didn't know any better. The sugary sweets is all we had. But I think the name of the game right now is healthy snacks that are kind of savory. The sweet stuff, man, it kind of sucks to say, but I think it has its core audience. But I think parents these days, I don't think they want to give their kids that kind of stuff. I think if it's up to them, they'll give their kid like avocado, guac dip, bananas, like whole foods. So to see that they're acquiring energy and protein bar types of snack companies, I think they're future-proofing themselves, and that's why I like their portfolio mix. And on surface level, when you take a look at their trading multiple of a 20, you might make the assumption that they're undervalued, especially because they're at their 5-year low. I think the last time they were like $55, I think that was, back in like February of 2021. I think the next stop is 54 and then $53. So you might be like, oh, they're undervalued, but I would say pause, because if you take a look at their food CPG peers that also make snacks, I mean, this hurts for me to say, right? Because I'm a shareholder of General Mills. Dude, their PE ratio right now is an 8.7, and they're also falling like a rock, okay? And if you take a look at Conagra Brands, they make like gas station snacks. Their PE ratio is a 9. So they could fall a lot further, because to go from a PE valuation of a 20 down to a 15 down to a 9, that means that stock price has a lot more to fall. But optimistically, I think their most closest relative that seems to live in New York City, Manhattan, would probably be Hershey Company, okay? And their PE is a 27. So that's the possibility of like what could happen, best case scenario. But you want to be level-headed and consider all of the factors, right? You could go into the direction of General Mills and drop to a single-digit PE. You could also go on the other side of having a PE that's closer to a 29 if you bake in the future EPS. So with Mondelez, yeah, dude, that's why I gave them a C+. I think we're going to be taking a closer look at their financials here. I think their financials and fundamentals, it's sweet, dude. It looks so good. But when you think about what's happening, the landscape, the regulatory pushback, and the consumer trends, it's the concerns that are why am I on Hershey? Let me go back to there. The concerns that are surrounding Mondelez, I think it's legit. And I think you do need to take that into consideration. Because not only are they projecting their sales to decline, you've got the whole healthy eating wave and trend movement that's picking up. More and more believers by the day. Which means when you think about it, fewer people want ultra-processed snacks that's loaded with preservatives, right? I think at the end of the day, when you think about your body, I think we all know like what we put into our body will manifest in our health. So the more junk food that you eat, it's gonna wreck you. Now, does the common person and citizen walk around with that kind of understanding and awareness of that kind of logic? I don't know. But the trends, on social media, you see it all the time. People are promoting healthy stuff now. Kombucha, green tea, matcha, organic this, paleo diet this. I think processed foods, it's in a really sticky territory right now. Then again, let me defend Mondelez because I think it's the middle class and upper class that's chasing the healthy stuff. But when I think about Mondelez, their core audience is folks like me, the people who just want something that's cheap, tasty, and comforting. But having said that, a lot of their customers are not going to be able to buy their products anymore using the government debit card or whatever it is, checks. So yeah, I mean, it's a mixed bag, right? And that's why I can't faithfully say they're going to be a B. I really don't think Mondelez is in the same territory as Salesforce, United Health, and Waste Connections. They're not. I think they're a step below that. But I definitely don't think they should be in the same ballpark as Ford or Big Bear AI. So having said that, let's go over my game plan when it comes to Mondelez. So this is straight from their earnings, slide 16. They gave a revised guidance, okay? They're expecting their free cash flow to be $3 billion for the full fiscal year when it ends in February of 2026. That's the first thing that I want to call out, and we're going to jump on over to their cash flow statement. I'm on a website, stockanalysis.com. This is what I use. You can use my referral link down below if you want. You'll get a discount on top of whatever promo they got going on. Jump on over to their cash flow statement. For the trailing 12 months, friends and family, right now, their free cash flow is $2.2 billion. They're expecting to finish out the year. So in February, their trailing 12 months is going to be at a minimum $3 billion. So if they can pull that off, I think it's going to be super sweet for them. If we break it down on a quarterly basis, if they don't meet that after promising we can do $3 billion, they're going to get massacred. So there's so many factors that can allow their stock price to get demolished. I think what's really holding them back is Q2 of 2025. They only posted Okay, it's all relative, but they posted only $3 million of free cash flow, which is a reduction of 99% year over year. Q2 of 2024 was $455 million. So they're going to have to make up for that and post a ridiculous number to bridge the gap to get it up to $3 billion of free cash flow. I hope they can do it. Again, it goes back to the whole coca ingredient price coming back down to earth. It might help them, okay? And then let's just start from the top right here, okay? Let's take a look at, I don't want to do it quarterly. Let's go annually, so every 12 months. When you take a look at their revenue situation, I would argue leading up to 2019, it wasn't that pretty, right? In 2015, it was 29.6 billion, and then it dropped down to 25.8. But ever since 2019, which is when they started aggressively acquiring and paying a lot of money for those protein bar companies and Cliff Bar types of companies, their revenue has been consistently growing up and to the right. That's phenomenal. That's checklist item number 1. If you can't grow your top line, don't even waste your time investigating this company unless they're improving their margins. Case in point, Altria, the tobacco company. I think their revenue has been stagnant for a hot minute. But dude, their stock price defies all the odds and it keeps going up, and their dividend profile is just delicious. So I really like their gross sales and what's happening with that. And if you take a look at their earnings per share situation, otherwise known as the profits per share, it's a mixed bag. It's up and down and up and down. And that's because as a food manufacturer that uses ingredients such as sugar, dairy, and cocoa, those commodities, those prices go up and down. Sometimes a gallon of milk, I'm not saying all the time, but there was a point in time when a gallon of milk was like 12 bucks. Likewise, a dozen eggs was like $8, right? Now, eggs is like $2 and a gallon of milk, I don't know, roughly what, $3.99? That means the cost of doing business is cheaper for them, which means their margins and profitability increase. So when the inflation is high, their margins are not as good. And that's reflected in their bottom line. So I understand the math that's happening here. But personally, as an investor or a potential investor, I'm not invested into Mondelez. I don't really like to see the whole up and down nature, but it's always helpful to understand why that happens. As long as the dividends are sustainable, I think for most of us, that's all we care about. And I think something else that's really important is I want to show you this. They're buying back their shares every single year without fail. Since 2015, 1.6 billion shares outstanding, they've just been buying back the shares nonstop. That's really freaking good. Less shares outstanding means their EPS can be financially engineered to look better than it is. And also, every share of Mondelez that you own has more quality because there's less quantity of shares diluting you. It's a good thing. Less shares will always be a better situation, okay? Jump on over to the balance sheet. This is kind of a yellow flag, I'll be honest with you, okay? Their cash on the books, at their highs, roughly what, 3.5 billion, but since then it's just been crashing pretty darn hard. I'm gonna go ahead and assume 2021 to 2024, they've been tapping into their reserves in order to finance and buy out their competition. So I think that's what's happening, which is a strategic use of their cash. I mean, what good is it to just hold on to cash like your Berkshire Hathaway unless you're deploying it in order to reinvest and grow the business, right? Their total debt situation, it looks pretty rough, okay? 21.9 billion. But I think the reason why I even take a look at that is because sometimes there's companies out here that have zero debt on the books. I just made a stock analysis video for Cal-Maine Foods. They have 17% of the egg market share here in the US. Take a look at how leveraged they are. Zero. They have zero loans. And that's why sometimes I like to take a look at it and see what their net cash to debt ratio is, because Cal-Maine has zero. A more helpful way to assess the health of their debt is the debt to EBITDA ratio. And while we're here, we'll be taking a look at some of their other metrics as well. And right now it's a 3.4. So that's another yellow flag. So what this basically means is when you take all of their loans on the books into consideration, how long it would take to pay it off from their core operating profits, which is the EBITDA, if it were to remain the same. So for Mondelez, it would take them roughly 3 years and 5 months to pay off all the loans. The golden standard is a 3, so they're slightly above it. Personally, I would really like to see a number that's closer to their 2024 or 2023 numbers, like 2.1 or 2.4. Now, I'm not a gambling man, but if I were to make an educated guess, I think this number is going to come back down as their profits are going to start going back up because the cocoa bean prices are coming down, thankfully for them, right? Take a look at their ROIC, the return on invested capital, when you take into account the shares that they issue and the loans on the books. How much profits do they generate for the shareholders, right? Are they being smart with the money that they borrow? I don't really like how it's decreasing from 2023, 7.5%, 2024 of 8.5%, down to 5.5%, which seems to be their historical average. Now, the golden standard for the ROIC is at least 10%. To see it at a 5.5, it's kind of disappointing, but at least it's not like a 1% or negative, okay? So that's okay. And before we jump on over to their dividend profile, I think this is really important to highlight and to look at. So historically, their dividend yield is somewhere around a 2 point whatever percent, right? Because their stock price is elevated enough so that their dividend yield is not into that 3% territory. However, what's happening with Mondelez right now is that their stock price is getting crushed so hard to the point where it's artificially pumping their dividend yield to be bigger than it is historically. That means their stock price appreciation is not keeping up with their dividend growth. So a 3.5% yield, because their stock price right now is historically lower than it usually is. Having said that, jumping on over to the dividend profile, I mean, again, I'll say it. A 3.5% dividend yield that's qualified, meaning it's going to be taxed at the capital gains rate of 0, 15, or 20%. Sign me the heck up. Payout ratio 70%. What does that mean? That means out of their earnings per share or their net income, the bottom line, 70% of that is going to be utilized to finance this right here, the dividends. The other 29% can be utilized to reinvest back into the business, to increase the SG&A, which is the employee compensation, or to overcome setbacks. The lower this number, the better it is. I think for a mature, established food CPG company like Mondelez, I think anything around 80% or below is healthy. 85% is a yellow flag. 90%, you better be waving that red flag, sir. Like you're an Alabama Crimson Tide fan. 70.1%, I think that's pretty healthy. But I think what's really important is this, okay? The dividend growth rate being, I guess we'll round up 9.5%. That's really good. Because if I show you their competition, I think it only goes up by like 1, 2, or 3%. General Mills, their dividend growth rate is 1.6%. If we look at Hershey's, theirs is not available because they're just maintaining that growth because the whole coca bean thing was so uncertain for them. They're like, dude, we don't want to gamble. We're just going to maintain it, which I would argue was the right decision from the leadership rather than increasing it and then having to cut it. Because once you cut that dividend, dude, I'm telling you right now, that's shooting yourself in the foot, both your feet. You're not even going to have feet anymore. Do not increase it unless you know for a fact that your earnings per share is going to be able to keep up and finance it while maintaining a moderate payout ratio. And if we look at Conagra Brands, I don't think they're increasing their dividend as well. So to see that Mondelez has so much faith in their bottom line and in their operations to be increasing their dividend at a 9.5% rate, I think that speaks volumes. Now, having said that, I already have a few shares of the grocery food CPG players like Conagra. I only have a few. I only have a few of General Mills. So it's like, do I really want another grocery food CPG stock in Mondelez? I'll be honest with you. Yes. I don't think I'll go balls deep and make it 10% of my portfolio or 20%, but to have a few shares, why not? Right? So, me personally, I'm thinking of buying a few shares of Mondelez if they hit my magic number. So for me, baking in a margin of safety, since their inherent worth right now is $55, for me, I would like to see something below $49.99 or less. However, realistically, I took a look at their technical indicators, and it does seem like they have a line of support at around that $53 range. So I think $53 is realistically the lowest they'll go, but if they penetrate below that, I think it's going to be a free fall. Meaning, who is to say it's not going to be $51, $47, or even $42 a share? That could happen in February when they report their earnings. But I think $53 as of right now seems to be their line of support. So that would be, like, if I really wanted to buy Mondelez, I think that's where I would start the dollar cost average. But for me personally, I'm not that gung-ho or crazy or that much in love with them. So $49.99. And if they never reach that price point, I'm okay. I'll live to see another day. And I say that because I think I already have enough grocery stocks like PepsiCo, General Mills, and Hershey. I'm okay. But I think Mondelez is pretty good. I would even argue they're way better than General Mills, slightly below PepsiCo, and about peers or rivals with Hershey. But I don't really feel like selling General Mills, if that makes sense. They could just stay in the portfolio. So my question to you is, what do you think? Do you like Mondelez? Do you have a rebuttal to some of the stuff that I talked about, right? With the weight loss drugs and their core audience losing their government benefits to buy their products and stuff like that. I mean, like, let me know your thoughts, right? I'm only one guy. Obviously, none of this is financial advice. I do think it's a pretty good company, and right now they're just going through a temporary storm is what I'm assuming, but I could be wrong. In the future, we could all be just drinking smoothies that's just super healthy, that hits all of our nutritional and macro needs, and then we never eat junk food ever again. That could be the reality. Do I see that happening? No, but it could happen, okay? And on an unrelated note, dude, check this out. Just had a newborn. Baby girl turned 7 weeks old today. And as I was holding her, I was just looking at her, right? And she looks at me usually with like cross eyes. She started to smile, and she smiled at me for the first time, like by looking at me. And I was like, whoa, I'm going to tell you right now, it's a crazy feeling because she's turning less and less of a potato and more into a little dividend growth investor. So I think it's kind of cool. Now, having said that, I want to edit this video and get it up. So I'll talk to you guys later. Stay safe. Good luck in the stock market. And if you want to give this a go, remember the Google Forms link. It's in the pinned comment or the video description. What do I mean by go? Your stock analysis request.